Broadcasting from beautiful, tropical Vero Beach, Florida, it's Money Nation with Ed Gardner.
Good morning and welcome to Money Nation. Today's special guest is Doyle Gustus from Cornerstone Select Advisors. Good morning, Doyle. Thanks for being with us.
How you doing, Ed?
I'm doing fantastic. So it's been quite a year. The last time you were on was about a year ago. Yep. My memory is correct. A little different market. I think we talked about some of the things we were worried about was increasing interest rates. Tell us what's transpired over the last year and where we are.
Well, I think interest rates basically have advanced, and due to inflation rates, et cetera, Fed is taking a little bit more hawkish stance. All those things we kind of thought may happen, and they did. And consequently, now we're in a situation where the market is backed up because of those rate increases. And we think probably rates are near their highs for a while. It looks like over the next year or so, we'll see rates, I think, trend a little lower.
For this year, clearly you wanted to make some adjustments back in the fall coming into this year, and the people that did make adjustments have done better. What are some of those things that you did that helped out your clients and your returns over the last 6 months from the beginning of the year?
Well, basically, from the equity perspective, Ed, we followed the basic premise that we always have been, that we're more value oriented. We're seeking the dividend as an adjustment to inflation rates, and we're looking for the dividend to be something that can be increased over a period of time, and thinking that interest rates would at some point in time start to be adjusted on an upward basis. As they started to be adjusted upwards, we reduced the fixed income portion of our holdings, and we allocated more money towards the higher dividend paying, with strong balance sheets, and the quality to increase the dividend over time. And the companies that had experienced or had been able to show that they were capable of doing that over a longer period of time. And that's made a big difference.
Yeah, that strategy's worked out quite well. You've done pretty well this year. Now, The question now is, you got people who are, maybe just didn't do much of their portfolio, and they rode the NASDAQ down 30%. And now they're looking at the stocks that have done well, the AT&T, Verizon, I think I saw today, there's only 3 stocks hitting a new 52-week high today, Bristol Myers, Pfizer, and one other drug company. Yep. So is that what should people do now, 6 months into it? Should they switch over to those stocks that have done well this year?
Well, I think that the interest rates themselves, Ed, are starting to dictate how that policy will work going forward, how the strategy will work, and I think it's going to continue for a while. When you look at the dot plot from the Federal Reserve Open Market Committee, I think what you see is rates probably going a little higher into 23, and then it looks like they start turning over late 23 and in 24. And if that is the case, then equities will have a more appropriate stance in a portfolio going forward, but it might be a year out or 18 or 20 months out. So we're basically, our position is that we're really paying more and more attention to the dividend side of the equation than we are the growth side of the equation. The stocks that from the beginning of the year to current, that had high multiples, exceedingly high growth rates attached to them, have done very poorly. I think those people that own things like that Facebook have been able to see that Facebook's down about 50%. And of course, at this point in time, it might be a feasible investment for somebody looking in the growth side, but we would probably lend ourselves more to the dividend paying stocks. I would rather own a Cisco today than I would Facebook for myself. The Cisco would pay you a dividend in the neighborhood of about 345, 350, and it has a decent forward growth rate. Looks like the analysts are pretty close into some nice growth going forward. It looks like they're at least the research that I've been able to see is indicating that. Our own research shows that Cisco is pretty much undervalued. So it'd be stocks like that are basically paying a good dividend. And I think the whole idea is that over a period of time, I think the last 5 years, Cisco's dividend has increased about 6% per year. So having said that, now we're in an inflationary environment, and the inflationary environment has really caused more pain for those people that have had those very, very high growth, high PE multiple stocks to be quite disappointed, I think, up to now. And going forward, I think you'll see those stocks that have the capacity to increase their dividends will do better. And the reason is very simple. As inflation rates stay high, and it looks like maybe they might stay high for a while, I think ultimately they'll come down, but I think the Fed will be successful in getting us back to more normal rates on inflation. But until that time, those basically play a very crucial role to total return to the investor.
What do you think about the energy? Energy was a great trade earlier this year. People moved in there, and it did very, very well first quarter into the second quarter, and it's given back a lot of those gains. What do you think about? Clearly, what we're seeing is you need fossil fuel still. You can't just turn a switch and you go to green.
Absolutely.
And basically people realize that now, but you had the stocks move way up and then back again. Where do you think, would you want to own those today?
I would.
And what do you think about those stocks?
Well, I think I would still own energy. I think it's a great place to be. Sure that the price of oil is going to fluctuate. It's going to, maybe it comes back to $100, but at $100 oil, those major producers are still making excellent returns on their investment, and the earnings numbers are going to be quite attractive going forward. So I would stay in the energy area for a while. I don't think it's going to go away. And that's probably one of our bigger overweights in the index right now is energy holdings.
There's an analyst on CNBC last week and talking about they're all giving their favorite stocks, but he talked about Energy Transfer Partners. That's one of your favorite stocks. Tell us a little bit about that one.
Well, Energy Transfer is we cut that one back a little bit. We cut the percentage of the holding back just a tad, and we started adding enterprise products, which is a little larger business altogether, a little stronger balance sheet, but in the same space. And I think that you'll just see natural gas prices will probably hold around where they are. They may decline a little bit, but it's still allowing those companies to have excellent earnings going forward, and I think that's going to continue. And of course, natural gas is becoming more and more important to the whole energy sector, so it'll do well. Obviously, those are domestic pipelines, but I think the energy price is going to remain pretty consistent up to where it is right now. I don't think it's going to drift backwards too far. It will come back probably at to 100, maybe a little under, but it's still going to remain pretty high.
And stay in that range, I believe, for the next year or two, couple of years.
Yeah, I think so. I've seen some research that's pretty convincing that we could have spikes up to 135, 140. That wouldn't surprise me. But obviously, if that were to happen, I think you would see some of the oil stocks like Chevron, even Exxon, Chevron, ConocoPhillips, BP, all of those major oils, I think, would respond, and their price would go along with the oil price. How much upside, I don't know what that would be, but I think it'll be quite a bit higher than it is right now.
I was listening to a podcast with Elon, and a lot of says something very interesting. He thinks, oh, like going out 10, 15 years, you're going to have more fossil fuel production than you do today, even with electric cars and windmills and solar, just because you're going to have all of Africa, which is going to be developing, is going to be using oil and things like that. And even with the transformation to green, you're still going to have oil being used, and even maybe more so than today. What do you think about that?
It wouldn't surprise me. I don't think that oil's a finite commodity, and I wouldn't be surprised to see that the price remain high, and I could see that happening. I don't know how to give you a good estimation when you're looking at 10 or 15 years. That's a pretty long way to look out, but it wouldn't surprise me. Let's put it that way.
Yeah. We're going to take a quick break, Doyle. Remember, listeners, any questions, you can always feel free to give me a call at 518-255-8854. We'll be right back with Money Nation.
All opinions expressed by Ed Gardner and or his guests on the Money Nation show are solely Ed Gardner's and or his guests' opinions and do not reflect the opinions of Cutter & Company or any of their affiliates. You should not treat any opinion expressed by Ed Gardner and or guests as a specific inducement to make a particular investment or follow a particular strategy, but only in as an expression of their opinion. Ed Gardner's and his guests' opinions are based on information he considers reliable, but neither Cutter & Company nor affiliates and or subsidies warrant its completeness or accuracy, and it should not be relied upon as such. Always talk to your financial advisor before making such decisions.
Welcome back to Money Nation. Doyle, what do you think for the next 6 months? You did pretty well structuring portfolios for the last 6 months. What do you think was going to be happening between now, the summer doldrums, and year end?
Well, Eddie, I think that the market will probably respond positively through the end of the year. I don't know exactly how it will come out, but I did before we decided to have this call, I did go to Bloomberg and I ran off all of the contributors to Bloomberg's estimates for year end for all the major companies out there. And I thought one of the interesting things was that for the S&P index, the average close, now this is the average of all of the contributors, the average close is 4,600. That's an average of all of the analysts out there. That includes 27 people in the space. And that's the majors like Bank of America, BMO, Citigroup, JP Morgan, Bank of America, Goldman Sachs, Morgan Stanley, all of them. That's the average. When you break it down, it looks like EPS is going to be somewhere in the neighborhood of 225 to 227 for the S&P 500. And I think that that's probably close. So I don't see any major difference between that and what we're looking for, and the research that we're doing now on individual stocks would seem to indicate that that's probably a fair number. When you look at them as a whole, the top estimate for the S&P 500 is Oppenheimer, and Oppenheimer's John Stolpas was at 5,330. That was the highest estimate. The lowest estimate was Cantor Fitzgerald, Eric Johnson at 3,900. And two, what I would consider to be probably the most accurate folks out there over the last few years that I've been watching this from Bloomberg, it's been Evercore, which is Eddie Hyman. They're at 4,300 and Goldman Sachs is at 4,300. They just dropped their estimate from 4,550 to 4,300. And I think those are probably pretty close. So having said that, that leads us to a moderate increase between here and the end of the year. And I think that that's justified. I think if earnings are in the area that I mentioned there, the 225 to 227, I think it's very reasonable that those targets could be hit.
How do you structure your portfolio going to the end of the year? Do you make many changes from what you have this year, or
no? I think we've done a lot of the adjustments that we needed to, And, since we're a value manager, we're still more interested in that dividend that I talked about previously. And we will keep that process going along. We have added a little bit of, we have gone back to add some of the preferreds. In the beginning of the year, we sold some of the preferreds, as you well know. And we now have started to add them back. This is an interesting fact that I found when we were doing our own research and basically when we were doing reviews of the portfolio. One of the things that I found striking was the correlation of the assets. So now it's working out that assets across the space are all correlated, including treasury bills and treasury issues. So if you would have bought a 10-year treasury on about February the 18th in that neighborhood, and you would have owned the treasury through 2 weeks ago, or 1 week ago Friday, you would have had a loss of principal of about 12.8%.
That's amazing.
So that's quite a shock. And people who did that are experiencing that. And so I went back and I thought, okay, let's look at the preferreds. So I went back and pulled the Bank of America 6% preferred. And I said, what was the highest point from the beginning of the year to the lowest point beginning of the year? And the preferred had a loss of 8%. So the preferreds were actually holding up pretty well. Now, we did not start buying any of the preferreds back that we had liquidated at the end of the year in early January. But we are now at a point where we're starting to add a few of them back. And why we're doing that is because a lot of those preferreds now are still at this point in time yielding between about 5.80 and 6.10. So if it is true, or if the dot plot is any indication from the Federal Reserve Open Market Committee that in 24 we get interest rates back to the 3 level, if that is the case, then these preferreds will hold up quite substantially, and they'll offer some downside protection to a portfolio and with less volatility. And of course, as you know, people that are coming to Cornerstone are basically hoping that we can limit some of the volatility in their holdings. So we are doing that, and it has been pretty successful up to now. And on the other side of it, if the earnings come through at the 225 to 227 level, we think that there's still some decent upside to some of those equities that are value oriented. And that would in turn, hopefully it would give people some capital growth between here and the end of the year. And we think that's very likely to happen. And, plus the dividends that they get. So total return should be hopefully something that they would appreciate by between June 30 and 12/31.
Plus, you're buying the dividends that are only taxed at 15%. Want to talk about that? The preferreds.
Well, basically
qualified.
Yeah, in the portfolio, we are buying all the dividends that we are purchasing if we can, and most of the time we can do this. We want qualified dividends, which obviously means then there's a tax benefit to the holder. For people that own or people that have retirement assets and IRAs, et cetera, it's not a direct influence to their return, but it does, I think, help because the volatility of those issues, just because of that tax issue consequence, those people are usually well served because the volatility is less than other stocks that are fixed income, especially fixed income, where they're taxed at basically ordinary income rates.
So what do we got clients? You got clients talking about some are calm, some are not so calm. Yeah. What are you telling the clients that at this point in time, maybe we should sell everything? I'm sure you've heard that before. What do you tell those clients? I think you got a couple points we talked about before.
Yeah. Well, look, I think that now's I think one of the worst times to do that. I completely understand the concerns that they may have, and it's a very reasonable concern. they're just fearful. But if you go back to 1973, 1982, 1987, and of course, I'm old enough to have been in the markets during some of those times, almost all of those times. And you go back to 2009 and 2020, every time this market basically had a very sharp and dramatic pullback, most of the time it responded usually within 12, 14 months. A lot of them quicker than that. For example, in 2009, we had the issue of the banks going out of business. People were very fearful. The economic conditions were going to be even much more drastic than they are today. And after Q1 2009, the index had rebounded about 10%. Then 3 months later, it rebounded almost 22%. 6 months after the Q1 of 2009, market was looking to be up in the neighborhood of about 38%. So holding the positions, if they were quality positions, now, there are positions that had to be, changed, but for the most part, the biggest part of the portfolio, the equity portfolio, rebounded very handsomely for people. So they weren't hurt. So, the idea for the individual investor right now is more than anything is, stick to the plan that you established when you started. You want to check the valuations of the holding that you have. Just make sure that they haven't changed drastically. And if they have changed, then do something. And when I say that, I would focus specifically on some of the more higher growth, higher PE things. Some of those stocks just are not going to bounce back. I mean, some of them will. There's a few of them that won't. So it'll take them, 5, 6, 7 years maybe to get back to where they were. So you want to just make sure that you check, and see, where those are and, what the future valuation may preclude, so that you can make an intelligent decision on what you want to do with it, buy it or sell it, or just take the loss and move on to something else. But really, the most important part of the whole equation, Ed, is for those people to remain in the market. Don't get to a point where you're going to panic and move out of the market, because as I showed, or as I tried to illustrate there, within 1, 2, and 3 month time frames, the market was up 11% in 2009. In 6 months, it was up 22%. So those people that held their positions, were basically treated well, and by the end of the year, it was back up almost 30%. Now the market did fall off, almost 43 or 44%, but still, the point being is the market did bounce back, and then later on in 2011, Q2, Q3, 2011, those holdings were right back to what they had originally paid for them. So there was no real terrible deterioration in the holdings.
Well, we both know the amount of up days is in a very small percentage of all the market trading days. If you get out of the market, you may miss vital upward moves in the market, and it's hard to time. So again, as long as, like you said, you got a good portfolio, good stocks, you should be sit there and ride it out. Especially now that it's already down so much.
Exactly correct.
Doyle, thanks for being with us here on Money Nation. Any listeners out there have any questions, you can feel free to give me a call. We want to find out more about Doyle. And remember, clients, listeners, anyone out there want to watch the old interviews, you can always go to YouTube on Money Nation, and you can search for all the old interviews we've done. Doyle, thanks for being with us. We'll have you back again in the future, and have a great day and have a great week.
Thanks, Ed. Appreciate it very much. Thanks for having me.
Thanks, everyone, for listening to Money Nation. Have a great day.